What's up, guys, and welcome to WSM Research. The Fed pumped trillions of dollars of new money into the economy to fight the pandemic in 2020. There is an emerging consensus that 2021 will see a large increase in inflation as consumers go out and spend their stimulus and unemployment money. Warren Buffett recently said that the economy is on fire, with demand far outpacing supply. Demand has surged so much that many restaurants are having trouble finding workers. This will almost inevitably lead to a sharp rise in inflation. Inflation troughed at 0.1% in May of 2020 at the depths of the pandemic. Since then, it has experienced a strong rebound. In March of 2021, the annualized inflation rate was 2.6%. As the economy continues to reopen, this trend will likely continue. There are certain stocks that will be hurt by the sharp rise in inflation, while others will benefit. In this video, we will be taking a look at one stock in particular that is extremely well positioned for the impending inflation. Keep in mind that we are not financial advisors, and this video is for entertainment purposes only. Make sure to do your own research before making any investment decision. Because the prices of commodities such as oil, corn, and steel are on such a fluid basis, meaning that prices change from day to day, they are some of the first goods to see their prices change with inflation. Think about gold, for example. Gold is sometimes considered the traditional inflation hedge. Part of the reason for this is because gold is a commodity whose price responds to changing demand pretty much every day. In addition, the supply of gold is more or less fixed, meaning that no matter what the value of money is, if the demand for gold doesn't change, the real price of gold shouldn't change much either. Other commodities, such as oil and steel, aren't quite the same because their supply can be adjusted in reaction to market prices, but the same principle applies that they will be quickly affected by general inflation. One reason for this is that a commodity like oil is highly linked to almost all sectors of the economy. If Berkshire Hathaway sees input prices rising for lumber in their home building business and is able to pass those price increases on to consumers, then they would logically also be willing to pay proportionately more for gasoline that their home building machines use. Gasoline is just another input. Or consider an everyday consumer who sees prices of everyday items increase by, let's say, 5%. They probably won't be so surprised if they see gas prices also go up 5%. Since oil is used pretty much in every industry, oil prices will be able to rise with inflation almost immediately. The same basic principle applies to other commodities as well, but oil is usually one of the most reliable ones because it is so pervasive in the economy. In addition to the inflationary tailwinds behind oil, some economists expect increasing demand and short-term inelasticity in supply to further push oil prices higher. In 2020, many oil companies responded to falling demand by cutting capital expenditures. In order to stop the bleeding, they put off investing in critical machinery and infrastructure necessary for oil production. As a result, in 2021, there will be a period of suppressed supply, while at the same time the economic reopening will cause unprecedented demand. When demand increases and supply decreases, Economics 101 tells us that prices have to rise.
You've laid out the demand story, you've laid out the supply side. How do prices go higher from here? Given the setup that we're seeing with what OPEC is doing, the story in the States, we know what's happening in Europe, but we're looking through that. It's all in the market, Jeff. Where do prices go? Can they be more elevated?
You know, our target's $80 a barrel on a Brent basis in 3Q. I think as you heard it from OPEC themselves, they expect demand to be up 3 million barrels per day over the next 3 months. Their supply is up 1 million. That means that the deficit that we're already in is likely to accelerate. We do expect inventories to be normalized by sometime late 3, early 4Q, at which point we need to start talking about bringing on new production. And that goes back to that point. There's no investment going on in any of these markets. I mean, you've seen a small increase in drilling in the U.S., but nothing really that significant. So I think the bigger point, thinking about not only is there strong demand going on in energy and metals and across the commodity complex, there's no investment in supply. Saudi faces an inelastic supply curve near term. The planning intentions came out yesterday, big disappointment. We've seen no greenfield investment in metals. Production in Latin America, in Chile, the exports are down 20%. I can keep the list going on and on and on. We don't have supply of these commodities. We got a lot of demand. Inventories are drawing. The upside here, I think, is substantial across the commodity complex.
Another consequence of inflation is its effect on fixed rate debt. Debt is just an agreement to exchange a lump sum of money in the present to a fixed cash flow going into the future. If inflation makes the value of money less in the future, then the value of the future cash flow is also clearly eroded. The liability of having to pay the future cash flow is what makes having excessive debt so bad for companies. No matter what happens to the economy or to the business, the company will always have to pay the interest expense every quarter. This can take up most of a company's operating profit, or sometimes more than all of it. The fact that debt payments are usually fixed is one reason why companies sometimes decide to raise capital by issuing stock in order to pay down debt. Even if their stock is not worth very much, if they have too much debt, then by reducing the debt burden, even if it means heavily diluting the stock, it could mean the difference between making a loss and making a small profit. The ultimate reason is that debt payments are fixed numbers on a calendar. They are defined in advance and do not change. But the value of those numbers decreases when inflation hits. Inflation is sometimes considered a transfer of wealth from creditors to borrowers for this reason. Companies that have low valuations because of their high debt could see their valuations rise to the level of their peers if their inflation-adjusted debt burden decreases due to inflation. One stock that will benefit from the inflation and rise in oil prices is Occidental Petroleum, ticker symbol OXY. For full disclosure, I own shares of Occidental. Occidental is an oil exploration and extraction company that operates around the world. Their business results are heavily dependent on the price of oil. To understand their oil sensitivity, let's look at their income statement. In the second quarter of 2020, oil slumped and they sold their oil at an average price of $23 a barrel. At this price, they were able to make $587 million of operating cash flow, excluding working capital. In the fourth quarter of 2020, they sold their oil for an average price of $41 a barrel. This allowed them to make $1.4 billion of operating cash flow before working capital. This is more than double what they made when oil was $23. In their 2021 guidance, Occidental said that a $1 increase in the price of oil per barrel will increase their cash flows by $215 million. For the full year of 2020, they sold their oil for an average price of $37 and made $5 billion of operating cash flow. The price of oil currently sits at almost $65 a barrel, and it could increase even further. Goldman Sachs forecasts an oil price of $80 per barrel before the end of the year. So it's not unreasonable to think that Occidental can sell its oil for an average price in excess of $70 per barrel for the full year of 2021. This would be $33 higher than the average price in 2020. Remember they said a $1 increase in oil increases cash flow by approximately $215 million. That means that a $33 increase in oil price will increase their cash flows by about $7 billion. This means that they could make operating cash flow of $12 billion in 2021. They say they will spend $3 billion in capital expenditures in 2021. Subtracting this from their operating cash flow gives $9 billion of free cash flow in 2021. $9 billion of free cash flow equates to roughly $9.60 per share, which is more than one-third of their current share price. So assuming that oil can increase to an average of $70 per barrel over the course of 2021, Occidental is trading at 3 times free cash flow. However, they will not use this money to pay a dividend. They are currently saddled with $36 billion of debt that they accumulated to fund acquisitions in the past. During the pandemic of 2020, they suspended their quarterly dividend. They say that they will focus on paying down debt before bringing back their dividend. Overall, Occidental is primed to benefit from high oil prices in 2021. They could easily make $9 billion of free cash flow, which they will use to pay down debt. The high debt load is a major overhang on Occidental's valuation. If they manage to strengthen their balance sheet, the stock should re-rate higher. Alright guys, that wraps it up for this video. If you like this content, make sure to like, subscribe, and share. As always, thank you guys so much for watching, and we'll see you in the next one. WSM Research, signing out.